Welcome back, everyone. This week we'll be discussing Organigram, ticker symbol OGI, the OG of Canadian LPs. Preamble. If you're the type of person who buys bombed out commodity names where their current cost of capital is below their marginal cost of production, hoping for a multi-bagger, then the cannabis industry might be for you. Remember, down 90% to down 60% is a three-bagger. It's worth keeping in mind that unlike traditional old economy hard asset industries where the industry is mostly consolidated, cannabis is a nascent industry. As such, I'm focused on those who I think will be the consolidators and or those who have thus far proven themselves to be efficient capital allocators. The story here is simple. A company with improving internal metrics, improving margins, who's establishing a foothold with top brands and wiser capital allocation in a growing industry which is not only trading at bottom cycle multiples, but whose stock isn't reflecting its growth due largely to the negative sentiment, apathy, and ignorance of the opportunity. And yes, they currently have negative net income. There's always a catch. This is probably a more serious audience. Let's see. This is probably a more serious audience due to the recent attention that I've been getting on Twitter. As such, I'm going to treat you as consummate professionals. Now, this is actually more in regards to my Substack than it is this YouTube channel, but for all intents, because the reason I say that is because I published this piece, a bunch of attention got to it on Twitter, some people shared it, blah, blah, blah. The viewership on the Twitter went up a lot, then the viewership on my Substack went up a lot, and I'm just now publishing this piece on here, so I have this suspicion, though, that it might get above average traffic, but I actually suspect it'll be less than my Substack, which is terribly embarrassing for the morality of the shadow banners of YouTube, but business as usual, I suspect. And I say that because, my Substack's growing quicker than my YouTube is, which it shouldn't be, and yet it is. So that's interesting. But I digress. To help catch you up to speed on my general thoughts around this industry, I'd recommend reading the following to open your eyes up to this industry in general. Some of your preconceived notions are right, but I also suspect many are wrong. Such articles as link in the article, so go over to there to click on them or watch the videos of similar titles on this YouTube channel. Cannabis and capital returns. Cannabis, a contrarian's choice. The cannabis industry and game theory. Cannabis, why I'm involved. It's not a real market. Pertaining to the U.S. side, which is tangentially associated and relevant in understanding the industry as a whole, I'd recommend reading Cannabis, Ponzi, and Zombie. As a final note, or watching it, if you like what you read in those articles, I've also written MSO Gang Unmasked Refugees from Delusion. It's an ungodly 15,000 word rambling that I had pent up for half a decade that outlays much of my thinking predominantly around cannabis speculators. However, there's also information pertaining to how I think of matters, such as there's much more, but that could get you largely, I don't know. If you don't want to read all of that, then I'll sum things up with the two images below. We went from everything ordering new builds and subsequently everybody's earnings getting hit at all-time lows. That would be the bottom of this image. Order new build, everyone's earnings hit all-time lows. To roughly here in the commodity cycle. Business investment declines, industry consolidations, firms exit, investors pessimistic. 2, improving supply side causes returns to rise above cost of capital, share price outperforms. OGI. This is not exhaustive, even though you might think I'm verbose, nor should it be. I'm not here for you to consign your investing decisions to. I'm going to say things to try and pique your interest and hope that it will prompt you to dig deeper if you're curious. Disclaimer, at times I will be using adjusted EBITDA. I've written my thoughts before on EBITDA and adjusted EBITDA. To put it lightly, I'm not a fan. In such articles as EBITDA and the cannabis industry, and EBITDA Cooking the Books, which is a video. I know for sure. But nonetheless, it's the world we live in. In the preamble, I noted that Organigram was establishing a foothold with top brands. Well, here it is. I can't remember how I made this circle. These red circles, so you see it covering the Shred X, Shred, and then, what does that say? Shredums. I actually like that circle I made. That's the takeaway from this video. Make good circles. Kronos, which is not the discussion of today, can be recognized under the spinach brand, which would be spinach second place in dried flour, then fifth place in infused pre-rolls, then fourth place in vapes, and then second place in edibles. FYI, Kronos they have positive cash from operations, are a net growing their top line, but I digress. I also noted that their internal financials were inflecting positively in the preamble. Well, here it is. And what you'll see, even though it'd be better if I compared it to something else doing atrocious, so you could see it, but otherwise all these charts look flat, but you can kind of see a bottoming at different time periods. July 23rd is a good one. And them inflecting positively, going from negative cash flow from operations to positive, albeit interim, and then EBITDA margin in the positive, and then gross profit margin in the positive, or not positive, well, it's been in the positive, but up and to the right at a very, very shallow angle. But isn't that something? And here is the year-over-year inflection. So I won't go through all of these, but some of them. Year-over-year, gross revenue change is 14%. Net revenue, 6%. Cost of sales is down 13%. Let's see. Gross margin up 36%. SG&A is down 3%. Adjusted EBITDA is up 56%. Net loss is, you got to be careful how you phrase this, because a net loss being up would to say that it's gone more negative, but it went from a big negative to a smaller negative. Valuation. Simply put, I don't believe that the market has fully recognized and thus has properly valued their improving fundamentals. Disclaimer, don't forget commodity companies look expensive at the bottom of cycle. This is no different. Yeah, they're a CPG, but I find it best to think of them in commodity terms. Figures were established on January 5th, 2025. For fiscal year 2024, Organigram is trading at 28.45 times EV to adjusted EBITDA and a 1.5 times EV to sales. However, if we were to annualize their Q4 numbers, then that means they're trading at a forward EV to adjusted EBITDA of 10.2 times and a forward EV to sales of 1.33 times. Remember, sales in this context is net revenue, excise tax deducted from gross revenue. This tells me that they're improving at their ability to convert sales into something that resembles and comes closer to actual profit. However, none of what I just said factors in the recent acquisition they made of Motif on December 6, 2024. I pronounce it Motif, and I'm pretty confident that's wrong. The only problem is I forgot the correct way to pronounce it. So with that said, I'm going to be pronouncing it probably wrong. Motif. Is it motif? We'll call it maybe, we'll see what I say. This acquisition is a big deal. It's a 37% increase to Organigram's EV and a 54% boost to Organigram's net revenue. Of course, private market versus public market valuations is often not the same, which means that it very well could contribute more than 37% to their EV. But that presupposes that the public market is paying much attention to this, which, as you know, is part of my thesis as to why Organigram is a good deal, i.e. they're not paying attention, but to some extent. Also, multiples are depressed when sentiment's depressed. I'd like to know a few things. Here, link an article, they are saying that net revenue from Motif was $86 million. And yet here they are saying Box Hot Motif brand made $158 million. Now, since we know that Organigram, Shred, fiscal year 24 net revenue was only $159 million, then we can conclude that this above image is gross revenue, not net revenue. This image right here. The difference being excise tax. As such, we can conclude that Motif effective excise tax rate is 45.5%. In this sense, it makes Motif not an accretive acquisition due to Organigram having an effective excise tax rate of 35%, meaning the acquisition of Motif will compress their margins. This would give the new and improved Organigram a blended effective excise tax rate of roughly 39%. Using Shred and Box Hot as proxies for the respective parent companies, Organigram and Motif, the new combined company's last 12 months gross revenue would be $386 million. $386 million at an effective excise tax rate of 39% would lead to net revenue of $234.46 million. As opposed to if Organigram magically and organically grew to gross revenue of $386 million while maintaining a 35% effective excise tax rate would equal net revenue of $250.9 million. Okay, so we have the combined entity tax rate of 39% with net revenue at 235. I'm going to stop saying the decimals amount, so 235 million, and the magical Organigram tax rate of 35% at 250 million. This is a disparity of 15.4 million as a consequence of merging with a company which has a higher effective excise tax rate, i.e. lower margin business, inefficiencies or scale, form factor of product mix. However, Organigram did note this. Significant cost synergy potential estimated to be in excess of 10 million to be realized over 24 months. That's promising, if it actually happens, because what it means is that those synergies will narrow that $15 million gap, meaning that the initial loss in margin might be manageable. If so, that would entail a company whose sales are 50% larger while maintaining the same margin profile. However, we'll need to be patient as these potential synergies are realized over a 24-month time span. Ultimately, only time will tell. According to the below image, if you know the actual source of this image, please share it with me. And you'll go look for this image and it'll be Mark posting it on Twitter. He told me, I'm just getting this out the way now, but others already had a comment. I know that. That's where I got it from. That's what the link in the image word goes to. But he said that it was from either LinkedIn or Instagram, I believe. And so I went to LinkedIn and Instagram to Decibel's page and such things and could never find this. I would like to know the source of it though, because maybe they said other things along with it. Plus, I like citing my sources and I did the best I could, but I don't know the ultimate source nonetheless. Anyway, according to the below image, the acquisition does make sense, as in it was cheaper to buy Motif than their own stock. In case you're wondering, Decibel is Decibel Cannabis, another Canadian cannabis company I own, but am not here to discuss today. Organigram's trailing 12-month adjusted EBITDA margin is 5.26%. Motif's is 5.46%. Organigram's trailing 12-month EV to adjusted EBITDA is 24.45 times, while Motif is 19.1 times EV to adjusted EBITDA. The acquisition of Motif allowed Organigram to gain access to vapes, the third largest form factor in which OGI was seriously lagging behind. If you can't build it, buy it. So that's what Organigram did. Perhaps they bought into a dying business. Not so fast. Grew from $35 million in net revenue in 2022 to $79 million in 2023 and has generated approximately $86 million in the last 12 months. I don't know the ins and outs of Motif, which means they could be finagling the numbers, but if they're not, then they appear to be doing well enough, albeit with slowing net revenue growth, but growth nonetheless. The tricky thing about net revenue is it factors in the excise tax. The question then becomes, is this a Motif problem or a Canadian cannabis problem? According to C3, link in the article, it's not just a Motif problem. As this image shows, state of the excise and how the excise tax is becoming more and more of a disproportionate amount of gross sales. I don't expect the excise tax to get much worse. The risk reward is to the upside as far as I'm concerned, demonstrated by the concentration segment next. Organigram valuation continued. We now need to tack on motive to Organigram to see what Organigram is trading for. On a trailing 12-month basis, Organigram is trading at 25 times EV to adjusted EBITDA, as opposed to the earlier 28.45 times. If we annualize Organigram's Q4 numbers as we did earlier, plus tack on the motive acquisition, then that brings us to a forward EV of adjusted EBITDA of 11.69 times, which seems like an underwhelming re-rate for a company which will be growing its adjusted EBITDA by 20% year over year merely due to the motif acquisition. This also presupposes that motif doesn't grow at all in 2025 and that none of those cost synergies manifest. With the motif acquisition, Organigram's forward EV to sales is 0.74, and presuming that Organigram annualizes their Q4 net revenue with the motif acquisition, then they're trading at a forward EV to sales of 1.1 times. With all of that said, the market seems to be ever so slowly recognizing that adjusted EBITDA growth and no longer pricing it merely on sales. Now here's the funny thing and the confusing thing. Those calculations I just ran, which included Motif's adjusted EBITDA, also include their EV. But guess what? OGI's EV still hasn't priced in Motif's full 90 million EV, assuming that the market isn't discounting the price paid due to thinking that OGI overpaid. Back when Organigram released earnings on December 18th, you could have bought OGI at roughly 5 to 6 times EV to adjusted EBITDA. Well, that's not the case anymore. And remember, even with 80% of Motif's EV now priced into the stock, none of this factor in any positive developments in 2025. Keep in mind, even if my numbers are off, they're directionally accurate and if anything, are understating matters. Concentration. The below image demonstrates that Organigram went from 7.5% total market share to 12.4% market share. The next image demonstrates that their motive acquisition will give them number 1 in market share in 6 out of 7 provinces. In this well-articulated headset piece, link in article, and below image, they've demonstrated and explained the dynamics at play in both the US and Canadian markets. FYI, this is the logical outcome of the ARCA development of new industries, which are outlined in the linked articles that I provided you in the preamble. It says, quote, while emerging markets see market concentration fall the first few years, mature markets show a different trend. Once the dust settles in the market, typically in the 10 to 20% range from the top 10 brands, market concentration starts to creep back up, albeit at a slower rate, as market leaders secure their slice of the market and work to grow their base. Mature markets such as California, Colorado, and Nevada have clear market leaders while also supporting a strong cast of competing brands. Canadian markets display this U-shaped trend clearly and in sync due to their unified market. Canadian markets display this U-shaped trend clearly and in sync due to their unified market timeline, though the level of market concentration is noticeably higher than their southern neighbor. When it comes to market concentration, new adult use cannabis markets start out with a large amount of market share possessed by a few brands. However, as the market develops, more brands enter and carve out a space for their brand, lowering the amount of total sales controlled by just a few top players. The mature market reaches a sustainable plateau, which looks like 10 to 20% of total sales for the top 10 brands in the US and 18 to 25% for the top 10 brands in Canada, before increasing again at a more conservative rate, reflecting the top brand efforts to grow their position as market leaders. As always, Headset has the data to help new entrants find their space in the young market while helping existing brands in mature markets find a path to sustainably grow their current footprint. End quote. You'll note that in that Headset article, they provided this image of the U.S. industry. Although Organigram is in the U.S., there's an important takeaway here. The reason that I think that the U.S. top brands have captured market share at a quicker rate in the U.S. is due to the more burdensome 280E tax. So far, I've been discussing effective tax rates to the tune of 35 to 45%. That's the excise tax. Well, in the U.S., it can very well be to the tune of 70%, meaning that the U.S. is going through a relatively accelerated culling process. There's other dynamics at play, but I'll leave it at that. Matter of fact, I have one more thing to say. Another differentiating factor is that many of the Canadian companies have or had big money backing them from alcohol and tobacco companies. As such, it has allowed Canadian companies to extend their slow collapse and buy them time to right the ship. It's a painful slow bleed on a countrywide and industry level. It is my belief that this has to some extent suppressed the prices of cannabis in Canada. However, according to the below image, things are picking back up. As a bombed out sector style investor, I don't even need things to be improving per se. I just need them to stop collapsing. It's a slow and steady game. This industry went full degenerate. It's for that reason that most people aren't thinking about this industry. As such, all that waste, overcapacity, frivolousness, and uneconomic business models need to get worked out of the system. As the below image shows, that's what's happening. I'm getting tired and this is getting long, so let's hurry up. Lightning round. 3, 2, 1. They have negative net debt. Although they have negative net income, they do have positive cash flows from operations, sometimes at least. They have big tobacco financially backing them. Here's the presentation on it. They have their fingers in multiple entities and are targeting exports. FYI, there's no usury excise tax on exports. Their U.S. exposure isn't so much them trying to sneak into the back door of the U.S., but more to help them out in what it is they're already doing. Take Phylos Biosciences as an example. If you want continued efficiencies, i.e. improving margins, then you need to invest in companies that can help you with that. If the excise tax reform does happen, then throw most of the numbers I've put in front of you out of the window because the stock would be ludicrously cheap. I wrote a piece a few days ago touching upon that subject, link in the article. I don't know if it's a video or not. It might be, might not be, can't recall. Why would the government lower the excise tax? Political expediency, to appease the liberal crowd during the upcoming election cycle. Lobbyists, Cannabis Council of Canada, become big enough. I generally disagree with the belief that if they don't, they'll kill the industry. My thought on that is that they'll just create a behemoth of a cannabis company if they don't ever change the tax structure. Maybe OGI will be that behemoth. They'll presumably change it when it gets bad enough. Those who are well capitalized will last longer, take advantage of bankruptcies, and fund growth outside Canada, which doesn't impose the excise tax. This image is from C3 2024 C3 Excise Survey results. It implicitly tells us that OGI is immediately doing better than 40% of the competition, at least on an EBITDA basis, because it's probably adjusted EBITDA. It's only getting worse and has become a survival of the fittest. Yet the catastrophe that will be needed to cause change is ratcheting up. Yet again, the fact that excise tax is becoming more and more of a disproportionate amount of gross sales, and that the CRA is cracking down, allegedly, on collecting their money. Or maybe the government will float out a BS proposal that's tangentially associated and a tease, but nonetheless is helpful in some minor way. Link in the article. But we shouldn't expect much from inept, perversely incentivized individuals, as noted here. I don't know that person. Leclerc said he tells AQIC members, manage your expectations because the way the excise tax share with the province is structured, only 25% stays on the federal level and 75% of the excise tax goes to the province. So the government would have to tell the provinces, hey, you know what? There's going to be $100 million missing in your account next year because we will take off the $1 per gram excise duty. So I'm not really sure right now with a minority government that they're going to do that, or that they're going to go there. It's possible, but I really doubt it. Provinces are craving for money. The federal government has a hell of a debt for numerous reasons, so I don't really see it happening, end quote. Then I have trends like this in my favor. Shift in American alcohol consumption by age. You see that 18 to 34-year-olds are dropping off while others aren't. Ultimately, I don't care about the whole tax situation except that OGI is caught up on their taxes and that the longer this nonsense continues, the better pricing they'll get for distressed assets. I have extensively criticized cannabis investors for all of their fixation on regulation and 280E, the U.S. crazy tax. as I noted in cannabis, the macro, meso, and micro. I said, it is my belief that you can choose good companies that will perform relatively better to a basket of industry peers with little to no knowledge of what's going on with the macro themes. The macro themes are an afterthought and bonus to me, not a crucial contingency of my investing thesis. End quote. Then on the illicit market front, some say that the illegal market is essentially stamped out, while others seemingly disagree. I actually like Margaret Brody. She's the CEO of Rubicon Organics, another Canadian cannabis company I own. Then we have the whole drama around THC inflation between corrupt labs, dishonest and or desperate owner-managers, negligent enforcement. You end up with a whole bunch of people lying about how much THC they have in their product. This distorts the market and hurts those who are doing right. All kinds of goofy stuff can happen in what's considered a so-called federally legal product due to the gaslighting done around it for the last 100 years, like this. British Columbia allowing cannabis stores to have transparent windows. You're allowed, you're fine, years after what you sell has been legalized on the federal level, we will now allow you to have windows that you can see through. Like, seriously, that should help put things in perspective. Yeah, you read that right. It was only roughly 18 months ago that cannabis stores didn't have to black out windows like they were wearing a burqa. Or how a single package of edibles can contain a maximum of 100 milligrams of THC, but it must be divided into multiple servings with each servings not exceeding 10 milligrams, right? So you can't buy a package of 20 10 milligrams edibles. No. Only a maximum of 10. Or how about them being largely prohibited from advertising, like they're a second-class industry? Because they are a second-class industry, regardless of whatever gaslighting you might want to believe or not. But they're not a third-class industry. There's multiple classes of industry. My point is, it's not all sunshine, but OGI seems to be at a reasonable valuation for a company in an emerging industry. Hopefully, I've said enough to pique your interest in one way or another. Thank you for watching. Until next time.